UnitedHealth is finally starting to move. The stock is up 8.5% after an amazing report from the Medicare and Medicaid services, citing an increase of 2.5% versus the 1% expected for those companies. This is really amazing for UnitedHealth and for most of those insurance companies. I talked about it in my videos that they will potentially increase it again, and they did. And this is really, really amazing. But I'm personally not celebrating this rally because United Health is still down 46% over the last year. It's been a terrible performer. Warren Buffett owns the stock, about 0.6% of his portfolio. It's now below his cost basis, and I would not be surprised if he potentially bought more of the stock, as this is a classic Warren Buffett turnaround with a lot of headwinds. They are mostly temporary. That should get much, much better in 2027 and in 2028. Now, United Health is a massive insurance company in the United States and even globally, serving 145 million people worldwide. About 95 million of them are in the Optum ecosystem, and about 50 million are in the insurance business, which is United Healthcare. Now, United Healthcare makes up for the majority of the company's operating income. The second one is 5.8 billion from Optum Rx. Optum Rx is the PBM or pharmacy benefit manager. This is really a hated sector in the United States because they're mostly the middleman where they negotiate between the buyers and the sellers, and they get a spread or a commission, and this spread could sometimes cause higher drug prices for people, although the spread is not as high as a lot of people claim it is. They've been saying they want to get rid of it for many years. It still hasn't happened. It's still here, and it generates 5.8 billion for United Healthcare or United Health. 7.7 billion is from Optum Health, which is mainly at-home care and at-home services, which is an amazing business, by the way. And about $3 billion come from Optum Insight, which is mainly a software as a service revenue. Now, United Health has undergone a massive transformation with the departure of Andrew Whitty, which he only owned 78,000 shares. Then the previous CEO came back, Stephen Hemsley, and he owns about 1 million shares. So this is a massive difference in terms of skin in the game and incentives in general. But Stephen Hemsley, he's well known for doing whatever it takes to get back on track for the business. And he's really willing to do the right thing, and he does not want to compromise. And so far, he has been doing exactly that. Now, if we look at the companies in general, United Health, Molina, Centene, there's so many of them. It's not just United Health. A lot of them are down 40, 50, 60% over the last year. You could say they're having their 2008 moment. Now, the reason for that, the common reason, is a much higher Medicare utilization ratio. And the utilization ratio has spiked up in a major way. They haven't expected this much utilization, which has increased the cost of care much more than their premium could cover. So the solution in this case is to raise the price of the premium, exit unprofitable markets, and get back to profitable growth. So it's mostly within their hands. They have control over it. And this is a temporary issue. It's not a permanent issue. And this is why United Health and many of them have put up price increases for 2026 and 2027. And we should see the benefits of them in the stock. So this is, again, one of the clearest turnarounds I have seen, where a lot of what's happening to them is largely due to their own mistakes, and it's all within their own hands to really turn it around. Now, the last report wasn't really too bad. They beat on earnings per share, slight miss on revenue, but it wasn't anything crazy. Now, guidance was terrible. They expected 2026 revenue guidance to decline 2% year over year. And this has freaked out the market because it was the first time in a decade, where United Health Group has declined in revenue, and it really shocked investors in general. Now, that was due to three main reasons. The first reason is them exiting the UK because they want to focus on profitable growth in the United States. But even in the United States, they had to exit about 3 million people because they made the calculations, and the cost of care for those individuals is so high that it cannot be matched by premium increases, and it just wouldn't make any sense. So they can't really serve them. and they had to depart from 3 million people, and they decided to focus on profitable growth. But the last reason for the decline in growth is mainly due to the transition of a new coding system for Medicare, which has impacted UnitedHealth by about $6 billion in 2026. So this is really, really bad. But all of them, again, are temporary and they're not permanent. Now, I told you that revenue is expected to decline 2% year over year, but earnings per share is expected to grow at least 8.6% year over year. So that really tells you that the company is focused on profitable growth. They're not focused on growing at any price, but on profitable growth. And once those temporary problems are gone, the transition issue and exiting the markets in 2027, you're going to have a combination of revenue growth and margin expansion as the company is focused on profitable markets. And I think you could see much higher earnings per share growth, potentially 19, 18, and even 20% earnings per share growth in 2027. And things are headed into the right direction. Now, there's a catalyst that not a lot of people are talking about, and this is the midterm elections. I don't like to discuss politics or elections in general, but there's a lot of expectations in the betting markets that we could have a change in parties in terms of Congress. If we do that, then we could potentially have much higher increases to Medicare and Medicaid than just 2.5%. This is well known. You could look at the history of those stocks. They tend to do really, really well once we have a different parties than the one we currently have, or we have mixed parties. They tend to get larger increases, and it tends to be extremely bullish for United Healthcare. So I would not be surprised if the stocks start to front run this potential outcome as we get closer to late 2026, which is why I'm still holding on my June 2027 call options, and I'm going to see what happens. Now, in terms of valuations, the stock is trading at about 15 times forward earnings. 15 times earnings is cheap for a company like UnitedHealth. The average is about 19 times. Now trading at 15 times. The company is expected to grow 9% in 2026, 12% in 2027, which I believe will likely be low, and 20% earnings per share growth in 2028. So you're paying right now less than 1 times price to earnings growth for the company, as the company's average earnings per share growth is about 15 to 17% over the long term. You're buying it below that, but you're also getting a decent dividend. So you get paid while you wait for the stock to play out. The dividend is 3.1%. The free cash flow yield is about 6.7%. So this is less than a 50% payout ratio, about 40% payout ratio. And it leaves them 60% for them to get back to doing buybacks. And they said they expect to do that as soon as the second half of this year. So you have way too many catalysts from a buyback program, a potential change in parties in Congress. You have the headwinds that are happening right now, mostly temporary. 2027 comparables on 2026 is going to look much, much better. And you have a decent dividend, and Warren Buffett could potentially buy a little bit more of the stock, and it could add even more certainty to investors and to the stock in general. But that's my opinion on United Health. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.